Good morning, good afternoon, and good evening, everyone, and welcome to the May 2022 Abaxx Investor Update Call. I'm CEO Josh Crum, and on the phone with me today are Abaxx Group Chief Economist David Greely and Abaxx Exchange Chief Risk Officer Ryan Ingram. Also joining us during the open Q&A to follow, I believe we will have CFO Steve Frey, CSO Andy Fedak, and Chief Commercial Officer Joe Rea. I'd like to start out by making a few comments regarding the format of today's call and update the company's plan for investor calls going forward. I'd also like to point out that we filed our March 31st financial statement overnight, which can be found on SEDAR and from links on our investor website. And together with our May 6th project update press release, we'll make up the formal filings to be referenced during this call. Although this isn't a financial quarter end conference call specifically, we thought it'd be important to wait and hold this call until after our latest financials were released. Going forward, given our current launch milestones, it would probably make sense to start holding these quarterly update calls around the time of our financial filings. So the next update meeting should take place around mid-August. And there'll be a lot of current development pieces coming together and should be a lot of activities to report on over the coming quarter. On today's call specifically, I'd like to update investors on the significant commercial engagement and market activity since our February investor call, taking place during an extraordinary time in global energy and commodity markets, and give an update on the FCM engagement required to get our Singapore-based exchange up and running, as well as walking through some of our technology updates. For this call, we've also prepared two short presentations from David Greely and Ryan Ingram. As most of you know from our Smarter Markets podcast, we put a lot of effort into market and investor education, as Abaxx isn't your typical development stage company, and frankly, there are not a lot of startup market infrastructure companies. So we feel it's important for investors to understand the complex ecosystem we've been investing in. And on a side note, I would also, in preparing, I was preparing the stat for a related presentation that I'll be giving shortly. And within the board and C-suite of Abaxx, our executives have been involved in launching no less than 9 or 10 regulated markets, exchanges, and clearinghouses. And none of them are straightforward or easy. And this is perhaps the most ambitious and significant one yet for all of us. But this challenge is also our greatest opportunity, and why mature businesses in our sector are some of the most highly valued companies in the world. So today we'll have David Greely walk you through some of the key topics of conversation around market volatility and risk management we've been having with global energy market participants during this unprecedented market environment. This is precisely the type of market environment where the transparency and risk management tools of the commodity market exchange and central counterparty clearinghouse are most needed, and where the shortcomings of existing market infrastructure reveals itself. Presenting the opportunities for and new challengers to serve the physical commodity markets in new ways. We also have our Chief Risk Officer, Ryan Ingram, presenting to investors for the first time. During his time at the CME, Goldman Sachs, and at the Hong Kong Exchange Group, Ryan has held leadership roles in a number of cross-market, cross-jurisdictional participant working groups and standards bodies tasked with implementing more resilient market infrastructure. Beyond the stresses and volatility taking place in commodity markets, there have also been some significant developments over the past few months with regards to exchange and clearing technology, particularly around real-time blockchain clearing proposals that are currently in front of the CFTC. Given that Abaxx has been investing heavily in this trend as well, we thought it was important to put this topic on our investors' radar as well. But before we turn to the presentations and a live investor Q&A to follow, I'd like to jump right into some of the key topics and concerns that have been on investors' minds during a tough market sell-off. I know that many of you are concerned about the decline in our share price this year. I want you to know that despite the low liquidity and sell-off, we continue to attract and retain world-class talent for our team. We continue working with an expanding set of industry-leading partners and market participants, and have a healthy balance sheet and the working capital required to proceed to launch. While we proceed to launch, market developments continue to support our business case and increase the size of our ultimate opportunities. The energy transition to a low-carbon energy system, war in Europe, and sanctions on Russia have moved LNG and carbon to the mainstream of commodity markets. These will be major global commodity markets, and they still lack reliable benchmarks for price discovery and risk management, which our exchange will provide. These market developments have also brought the shortcomings and points of failure in commodity markets that we have been building the business to address in public consciousness and to the public consciousness and daily headlines. Billion-dollar margin calls are becoming routine, the debacle in the LME nickel market, and commodity trading firms asking the ECB for emergency funding liquidity all highlight the critical need for better tools, for better technology and risk management that we've been building. In short, the commercial need for what Abaxx is building is now widely recognized. The long-term opportunity has never looked better. In the short term, however, these recent events created extreme volatile markets and reduced our prospective clearing members' time to focus on onboarding a new exchange and clearinghouse. As we discussed a bit in our last update, we chose to use this market timing as an opportunity to accelerate the build out in the planned second phase of our exchange and clearinghouse technology platform. To this end, last week we announced that we are partnering with Xberry and Bay Markets, two great teams with forward-looking CEOs who have established themselves as experienced innovators in developing the next generation of exchange and clearinghouse IT infrastructure. We're exploring the potential to include these phase 2 systems in our initial exchange launch, which will be dependent on achieving development milestones and regulatory approvals. While our technology teams are working towards launch with a next generation IT platform, our commercial teams remain in continued dialogue with commercial market participants, refining our product specifications and working towards onboarding with our clearing members, which we anticipate in the second half of this year. I expect we'll be diving into all of these FCM and technology timing issues even further during the Q&A as well. But the final comment I want to address before turning the presentation over is regarding the base carbon listing and some of the concerns and feedback I've received around our focus and execution after the shaky early listing of base, just days after the Russian invasion of the Ukraine. I'm addressing these market events today, of course, as CEO, but also as the company's largest shareholder and investor. And in putting my investor hat on for a moment, I should preface these comments around valuation and investment horizon with the understanding that not all shareholders have the same capital duration to weather short-term setbacks and volatility. But that said, I believe the market is significantly underappreciating the value creation being achieved both in Abaxx and base in such a short time through our voluntary carbon market-related activities. Base carbon is currently trading at a near zero enterprise value at the moment, with a public market cap roughly equal to the cash raised over the past 12 months since founding the company. But even so, this asset represents a near liquid, almost $13.5 million asset on our balance sheet as of the March 31st mark-to-market financials. Combined with the near $20 million in working capital, the Abaxx balance sheet gives us plenty of runway to weather current market storms and achieve transformational business objectives in both companies over the next 6 to 12 months. With that all said, as a long-term owner of this business and a business highly capitalized in human capital, where all founders and executives are in this with significant skin in the game, I bring up these valuation discussions in the context of doing everything I can as CEO in this market environment to manage the company away from the position of having to sell equity in either base carbon shares from our balance sheet or new equity dilution in our Abaxx listing, as long as I believe the market is significantly undervaluing both equities before our key milestones. As a small example, I believe base carbon is well positioned to execute on their project investment pipeline over the next few years, with cash flows starting as early as next year in their initial projects, and therefore will be in a position to be buying back our royalty within the next 5 to 7 years for $150 million US, which would represent well over $225 per share in fully diluted Abaxx shares alone. Ryan will also be discussing the trends in technology and regulated global clearinghouses in a minute, which Abaxx is fully positioned for, and therefore have been multiple and there have been multiple recent clearinghouse sales, primarily for licenses and infrastructure, X-key technology, that have been sold for an excess of $100 million, mostly net of their cash flow value. So the approximately $30 million to date invested in our clearinghouse and market technology stacks are well positioned for many outcomes and strategic scenarios. This all goes to say that as a fellow investor, I don't think the current share price reflects an even conservative discount in some of the parts, or even a one of the parts probabilistic discounting on our clearinghouse or some of the opportunities we've built in the voluntary carbon markets. And therefore, the group's focus must be on executing and delivering more certainty in these assets over the remainder of the year and realize this value for our shareholders. Again, I'm sorry to have to be talking about the share price at this time when we're fully funded and there are many internal opportunities that will require focus the next few quarters. But I thought it was important to address some of the concerns around potential dilution or stock sales in Abaxx or base, which is currently not on the table, and especially before delivering all of our milestones in both companies during the remainder of 2022. We'll be covering more of the FCM updates and milestones, the base carbon listing, and the balance sheet during the Q&A. But I'd like to turn the presentation over to David to explain some of the market feedback we've had over the past few months. So with that, maybe I'll turn it over to David.
Thanks very much, Josh, and thanks everyone for joining us today. As Josh said, I wanted to go over some of the recent events and their market implications for the markets that we're involved in. Of course, the biggest event was the Russian invasion of Ukraine and the subsequent sanctions on Russia. When I was going back through my notes, I was a little surprised to see that happened just a few days after our last quarterly webinar call. And while those actions certainly have had tragic implications for many's lives, what I wanted to focus on are the market implications. As an economist, you often take a little bit more of a detached view of what's happening in the world. But given that we were out engaged with prospective FCMs and market participants over much of this period, and I was out with our commercial team, I thought I would walk you through, kind of the evolution of the conversations happening in the market, our conversations with market participants, and, at the end, the upshot I see for what that implies for the markets that we're working in. Starting off that soon after our last quarterly call, I was in London meeting with commodity trading firms and FCMs with Joe Ray and our commercial team, right as the sanctions on the Russian financial system were ratcheting up in response to their invasion of Ukraine. And, you had the freezing of assets of the Russian central bank. You had the removal of Russia from the SWIFT transactions processing systems. And in our meetings, you were beginning at that time to hear the first rumblings of the greater implications for markets that were to come. I remember sitting in a meeting with one of the largest physical commodity trading firms where the head of trading remarked that they had just that week been getting a $1.5 billion margin call. And while they were able to meet it, that was certainly an unusual thing by orders of magnitude compared to what they were accustomed to experiencing. And when I look back, those multi-billion-dollar margin calls have become much more routine and normal as the events have continued to drag on. And so in those early days, there was a bit of a feeling of, oh, isn't this unusual? Will this go back to normal quickly? I think what we've seen over the subsequent few months is that the higher prices and increased volatility and greater need to manage risk are with us for quite some time. Following that week in London, we went down to CERAWeek, the big energy conference for the energy industry in Houston. And during that time, you were seeing further sanctions on the Russian economy. And it was amazing how quickly the conversation had reset itself. Conference planners were very focused on, of course, the energy transition, as are we, and the need to move to lower carbon energy. And some of the areas of those conversations have always been very pragmatic. But there's often been a tale of, people wondering how quickly we need to go off fossil fuels. Is LNG a transition fuel or not? And I think what we saw in CERAWeek was a real rebalancing of the conversation, and the recognition that you need not just responsible energy, but secure energy that's reliable and affordable. So a rebalancing of that conversation that I think has been very healthy. Also that week, you had the LME suspending nickel trading and canceling trades after prices spiked to $100,000 a ton. And I think that was, you're starting to see that a number of these, structural issues build into legacy exchanges, legacy markets that Josh has been talking about for years as being problematic were starting to reveal themselves more publicly under the stress of the higher, more volatile prices. So some of the opacity in OTC positions, some of the mishandling of risk on the exchanges really came to the forefront, and it added a new risk that FCMs and counterparties need to deal with now, which is settlement risk. Once you've had a trade and it's confirmed, people typically would feel that that was a done deal. And of course, with trades being canceled retroactively, it's another risk that needs to be taken into account. Also, that was a lot going on that week in the world. Also that week, you had the European Commission first proposed its plan to end Europe's dependence on fossil fuels by 2030, the Repower EU plan. And in that plan, I think what was significant from my perspective was that over the course of this year, the European Commission was proposing cutting natural gas imports into Europe from Russia by about 2/3. And of that gas, about trying to make up 50% of that cut in gas through LNG. And that's a real signal that LNG is a transition fuel and necessary for energy security. So really pushing LNG to the center of global energy security in a way that it wasn't a year ago, but could be foreseen to be. And then as we moved on, I think the week of March 13th, you saw something quite unusual for people who know the culture of commodity traders and physical commodity traders. They tend not to be people that look for government assistance or seek government assistance, but the European Federation of Energy Traders asked the European Central Bank for emergency liquidity funding because their ability to post those, multi-billion-dollar margins on physical cargoes was creating a strain. They asked the ECB for liquidity funding, which the ECB later denied, but it was pointing out the pressure in the system, the need for more efficient use of collateral and more efficient use of margin. And you're beginning to see some of these market issues potentially spilling over to become, more real-world physical issues if those commodities that we need to eat to power our world and to keep things moving have difficulty because of issues like collateral and margin, which are things that people outside the trading business typically don't pay a lot of attention to. We finished up, the end of the month, the FT Global Commodity Summit was held in Lausanne, Switzerland. And there you really attract some of the largest physical commodity players in the world, largest commodity traders. And I think what you saw come out of that was the general view is you really moved into a higher price regime where markets are reliant on demand destruction to balance the markets, creating high and volatile prices and lots of risk to manage. And that people need better tools and are willing to give transparency to get better netting, move positions to exchanges, and that the world, needs secure, reliable, affordable, and responsible energy. And so those were many of the recent events and our experience of them as we were out with FCMs and prospective market participants. And I wanted to turn then quickly to the next slide, which has, kind of the upshot of all this. And the upshot, from my perspective, has been that the commercial need that we've been talking about for a number of years now for better benchmarks, better technology, better tools for risk management is now seen as urgent within the commodity markets and widely recognized, even publicly. Probably reading more about risk management and margin and collateral in the business pages than one would have in quite some time. And so in terms of some of those pieces, I'll just move quickly. I think a couple of the key points. LNG has really moved to the center of the energy market conversation, still lacks a reliable benchmark for price discovery and risk management. When Europe's accepting LNG as a transition fuel, like they did in the Repower EU plan, it's really shifted the conversation. At the same time, when you have this flotilla of LNG heading to Europe, trying to offset those lost Russian imports, you are seeing the strain of unsuitable hedging instruments creating basis risk. So TTF, the benchmark for pipeline gas in Northwest Europe, has been trading as much as $9 an MMBTU below the price of LNG in Northwest Europe because there's not enough regasification capacity to bring all that LNG in. But you can see that if you've got a $9 gap on your hedge, that's more than the price of gas in the US is the difference, is the basis. So we really see a need for well-designed futures contracts that are designed in collaboration with commercial market participants, because that's something we hear over and over again, is that they're not being talked to by people other than us, that our collaboration is unusual to their experience. Also, that inefficient margining and collateral use is creating those liquidity pressures, like we saw in their move to go to the commodity traders move to go to the ECB. And it's highlighting the need to create the right level of transparency and more accurate assessment of positions across exchanges and OTC markets. And it's created a bigger role for exchanges by providing central counterparties, which relative to bilateral OTC markets, raise liquidity, lower credit and counterparty risk. So it's creating a desire to potentially move more positions out of OTC onto the exchanges to try to get more efficient margining and collateral. And then finally, the slow clearing and insufficient transparency into positioning that we've been seeing is creating credit risk and highlighting a role for the technologies that we are producing for faster execution and quicker clearing. We recently had Walt Lukin, from this president and CEO of the FIA, on Smarter Markets as kicking off our Systems at Risk series. And he once again points out the role for FCMs and intermediaries and the need to make their ability to work in the markets more efficient. A lot of this involves using technology for faster settlement and quicker clearing. I think the FTX proposal to move to real-time clearing is one end of that spectrum. And Walt testified on the FTX proposal last week in front of Congress. It's probably worth listening to if you can hear the videotape. But there's obviously what's happened is there's a lot of focus, given these market developments, on the need to manage risk and on improving markets so that they can better handle these types of pressures and strains. And that's, I think, a big takeaway from what we've seen in response to the events of the past few months. So with that, I'll stop there and turn it over to Ryan, who can give you a much better discussion of how we see our approach to risk management and the needs in today's markets. So thanks, Ryan.
Thank you, Dave. Indeed, monumental and transformative times. For purposes of introductions, I'm the Chief Risk Officer of Abaxx Exchange, a role that I've held for almost 2 years. Before joining Abaxx, I've held risk policy and regulatory analytics roles at exchange groups, including Hong Kong Exchanges and Clearing and CME Group, and also similar roles on the banking side with Goldman Sachs and ISDA. I've been involved in developing more robust clearing risk practices and the regulatory initiatives that followed the financial crisis of 2008, with further hands-on experience managing clearing member default events, including the demise of MF Global. Such events and initiatives that followed were transformative in that the prominence of clearinghouses and the vital role that they play in the financial markets has increased significantly. It is my personal view that we're on the cusp of similar reforms and evolutions as it relates to the commodities markets, which is rightly aligned to our broader mission that market infrastructure such as Abaxx will play an increasingly important role to provide solutions to our market. Further, the recent volatility in market events have rightly invited more attention to vulnerabilities and risk exposure that's present in the commodities markets. And specifically, it has brought considerable attention to the efficacy of clearinghouse risk management practices. This is very much to our interests and also because it has renewed inspiration and motivations to embrace technology solutions that can unlock efficiencies and better optimize the many significant functions and salient features of a clearinghouse. Turning focus to Abaxx perspectives, risk management has indeed been a founding principle of Abaxx Clearing and has been integral to our development efforts and management decisions. Throughout this process, we have been minded by industry best practices, extensive stakeholder feedback, and increased attention to opportunities for technology empowerment. All that said, I feel it's relevant to provide context and background to how clearing risk policy has evolved since the financial crisis of 2008 and during which time I became increasingly involved in the very thoughtful and comprehensive analysis and international discussions regarding risk framework enhancements. Indeed, the financial crisis was the catalyst for the many post-crisis reforms that followed, many of which stemmed from the leaders of the G20, who agreed to develop and consistently implement agreed-upon recommendations to strengthen financial stability. For a clearinghouse, the most significant initiative and what I refer to as an achievement was the establishment of enhanced and harmonized international standards for CCPs. These were established by an international standard-setting body, CPMI and IOSCO, and are most conversationally referred to as the PFMIs. The PFMIs are held in very high regard and for the most part are implemented consistently by clearinghouses globally. For Abaxx, as a new clearinghouse, the PFMIs are foundational to our overall risk program and very much intentionally inform our strategic decisions for new technology partners. Indeed, we anticipate that our commitment to strategic steps forward will continue to make Abaxx an appealing market infrastructure. Like many, we've been following the recent developments and lively industry deliberations on FTX's novel approach to non-intermediated central clearing. While such risk practices do already exist today, I believe that it has very much motivated constructive dialogue on risk policy approaches to margin practices, exposure reducing liquidation practices, and the sizing and quantum of financial resources available to manage events of clearing member default. That said, we very much welcome the innovative thinking and what can reasonably be viewed as the industry's interest to perform a stock take of current practices and how and where efficiencies can be realized. This is in fact part of the Abaxx motto, and it remains our continuous commitment to identify such burdens and inefficiencies and provide more systematic, technology-based solutions for the betterment of the industry. On the whole, the increasing systemic relevance of clearinghouses has solidified their role as critical market infrastructure. And as a positive consequence, risk management is not only a core feature of the clearinghouse, but also a critical feature to the stability of the broader financial markets. Personally, I'm very excited to be part of these discussions and the evolutions in the commodities markets, and very much look forward to further engaging and enhancing our approach as we progress to formal launch. With that, I'll conclude my comments and turn it back to Paris to lead our Q&A. Thanks very much.
Thank you, Josh, David, and Ryan for those market insights and business update for the shareholders of Abaxx. We'd like to turn to the Q&A portion of the shareholder update, and we'd like to thank those of you who have submitted your questions in advance, and those of you who have submitted questions via the chat function in this webinar. We will aim to answer them all. So starting with questions that were submitted to our investor relations inbox. What is the probability that Abaxx will have an actual physical trading platform for LNG up and running in 2022?
Thanks, Paris, and thanks for the question that was emailed in. So again, I think if you look at some of the recent market of events and some of the announcements and disclosures we made over the last few months, our first priority is working with the core group of FCMs that we've identified and get them on an upgraded technology platform. We believe that using some of the volatility in the market as an opportunity to advance some of the technologies is the right decision. Again, as evidenced by the recent happenings in the clearinghouse technology landscape that Ryan's just gone over. So again, I think we've explained a few times how it's not necessarily a linear path to launch given the different pieces of the market participants. But I will say that over the last few months we have identified the core group of FCMs that will be working with us, and in our new technology. Our new technology contracts that we've disclosed over the past week or so. We will be working on what we call a day zero to start working on integrating the FCMs into the new platforms by late July and August. So we should have a substantial update on that in our next quarterly call. So maybe I'll probably preempt a question and a couple of questions that I saw coming into the Q&A that's sort of on a related note, and talk a little about the difference between call it Abaxx Technologies and ID++. looking at that as sort of one vendor, particularly of ancillary services to the exchange, as well as the new contracts that we've had with that we've just disclosed with Bay Markets and Exberry. So with Bay Markets and Exberry, that's our clearinghouse, our core clearinghouse software, as well as trading software, respectively. These are new engagements that we've taken. As you may recall, we initially engaged with Cinnober, which is a NASDAQ company, in the early parts of this project. Since then, there's been a lot of technology advancements and I guess new software stacks, particularly that are more cloud focused and being developed over the last couple of years, as you can imagine. And so again, we've taken this opportunity to upgrade to some of the or evaluate. It's actually being added to existing systems, but insert additional vendors in Bay Markets and Exberry. Now, these products are not specifically the web, call it the Web3 and the ID++ related technologies. That intellectual property and that piece of the ecosystem will remain within the Abaxx group. So really at this current time, you have sort of four key software vendors. Abaxx Technologies, which is working on the Web3 aspects using ID++ and its key use in digital signatures and digital contracts within the IT infrastructure. Again, we still currently have the legacy contracts with Cinnober NASDAQ. And then again, we've added two, we think excellent development teams for some core pieces of the exchange and clearing technology. I guess a related question to that is, sorry, I had my questions up, but pull them over. Was to kind of talk a little bit about our technology team and why we haven't disclosed, a number of a number of our technology team as we have with some of our commercial leadership. I would say, there's a couple things to say on that front. Again, number one is the Abaxx Technologies portion of the total infrastructure build is just one part of a very complex, ecosystem within the technology stack. Including also the ISVs and some of the market connectivity, or some of the distributors of our market to connect to internal bank and trading systems, external to our part of the technology operations. But that said, I'd still say over a third or even 40% of our budget is still spent on software development and invested in a lot of our new technologies. And actually for competitive reasons, as you can imagine, blockchain full stack engineers, that can both work in regulated market infrastructure as well as some of the new Web3 technologies is a very specific skill set. And we've been sort of careful on disclosing all of the pieces of our team for intellectual property reasons. And let's see, I think there was one other. Yeah, actually, maybe we can move on to the next question. I'm sure there's going to be more technology questions as we go.
Great, thank you for that, Josh. And in terms of these technical updates, would there be any further delays on MAS final approvals based on those technical updates?
Yes, so with the new filings, we have notified MAS. And again, this is sort of a constantly evolving system. And we will be working with the MAS on our final conditions. So I wouldn't say that specifically, other than again, sort of pushing our day zero timeline with FCM integrations. at this time, we don't see any material change in timelines for these new vendors otherwise.
Okay, excellent. There are a few more in-depth questions about on the tech side. Why is there such a dramatic gap in Abaxx's tech leaders' credentials versus exchange of finance leaders?
Yeah, we addressed. Yeah, that's one we addressed.
Okay.
I sort of summarized.
Okay, I see. And is there any key problem to be solved that's not a tech problem but a market problem that Abaxx would be addressing?
Yeah, I mean, not at this time. As we've discussed before, we really are launching, a generally, within existing frameworks and infrastructure of centralized clearing. So our initial contracts, although the contracts themselves, the commodities themselves, are not currently existing in the marketplace, the actual infrastructure and systems are standard practice within physical delivery contracts. But that said, particularly given some of the events around LME, we do, I'd say as more of a longer term investment, we do see some opportunities for technology to solve one key problem beyond just just beyond the real-time clearing issues that were raised by FTX. I think the other issue is around the nature of commodity trading and commodity margining. So one of the big problems in commodity markets that's very different than, say, pure financial markets, such as treasuries and treasury basis trades, is that for the large extent, commodities, being physical assets, can't be pledged as collateral in the same way to an exchange and clearinghouse as a purely liquid financial product. The commodity markets very specifically needs balance sheet lending and bank intermediation to essentially to bank lend to the supply chain of commodities. So it's very hard to post a barrel of oil, physical oil as collateral to an exchange. So we do think that there are technologies, particularly changing the settlement time and the clearing time, and really the value at risk, sort of duration. We do believe that new technologies can help improve that. And this is a new framework that needs to be worked through with regulators and all sorts of market participants. But we do think some of our technologies around ID++, our digital signatures and contracting, digital contracting will allow eventually for pledging commodity collateral. So this could be a major development in the long term, as it would give us the ability to gain market share in all commodities and not just our new commodities that we're listing. So again, probably a little bit in-depth answer, but I guess I do stress that the technology aspect of what we do is very important, even though day one, we will not be focused on introducing too many sort of newer exotic technologies in the market.
Great, thank you for that. There's one interesting question with relation to gold. What is the thought process behind why Abaxx has invested 1/3 of its cash equivalents and short-term investments in gold?
Yeah, so maybe I've seen a couple of questions on the balance sheet and our liquid assets on our balance sheet, and I just want to give you a little bit of context. We really look at our liquid sort of currency reserves, particularly in a zero interest rate environment, as really three FX allocations that we allocate to, and that is the Canadian dollar, the US dollar, and gold. I think we were ahead of some of the FX and markets last year. After our Canadian fundraising, we went almost all US dollars in Q2, Q3 of last year. And if you notice over previous quarters, had significant FX gains with our US dollar position. We subsequently moved some of our FX position into gold in late last year, anticipating the rise in commodity volatility and inflation. And so, I think we had a small mark-to-market gain in gold as well at year end. And then we've, as a board, we've decided to move more of some of our long-term sort of treasury collateral or treasury that will eventually become clearinghouse collateral. We've decided to move some of that into gold, given some of the significant sort of tail risks that have introduced themselves in the market. We believe that we're very close to the commodity world. By nature of what we do, we're very close to some of the severe financial systems that sort of exist in some severe risks that exist in the financial system, particularly around commodity volatility and the war in Europe. And so we believe it's prudent that some of our FX reserves, particularly in a negative real interest rate environment, be also allocated to gold. Now that said, these assets and these allocations can be changed at any time. And our approach in general is to keep all of because of our spending and investment profile, to be keeping all of our assets in very liquid forms.
Great, thank you. And just shifting gears to a few questions that have come in about carbon markets. One being an update for plans for carbon futures contract on Abaxx exchange, especially in light of Air Carbon Exchange's plans to launch a futures exchange in Abu Dhabi. And then a sort of related question about the increasing risk of greenwashing. How would Abaxx exchange support companies that are using the exchange in mitigating that risk of greenwashing?
Great. Yeah, no, those are great questions. So first I'll maybe address the sort of the difference between what Air Carbon is doing and what Abaxx is doing. So as most investors know, we were the lead investor in their Series A, sort of their pre-launch investment. And I am pleased to say that they've subsequently increased the valuation in subsequent rounds, and we're actually very excited about the business models that they're rolling out as really being standard setters and innovators in the OTC carbon markets. So Air Carbon is really focused on the spot markets and creating some of the standards around grouping or basking different environmental markets, and they're really taking a hub and spoke approach where they've announced a number of joint ventures, so that they have a lot of central onboarding, KYC, creating central market liquidity, but doing it in a very regional basis in spot markets. So, given the nature of the voluntary carbon markets, this is a unique approach and very different than the sort of brokered physical commodity markets that we're used to, in probably more centrally brokered markets. But that said, and I was probably taken aback a little bit by their announcement with the partnership with Abu Dhabi around building a clearinghouse. But what I've learned is that they are very much focused on a blockchain only focused business. They simply, it's a very long investment to build a traditional clearinghouse. And so what they're really looking at is a blockchain focused business. So I think that's where we probably differ in our near term approach. As far as our own sort of approach to the voluntary carbon markets, there's really two things that we're doing. Beyond our investment, of course, in Base Carbon, which is an upstream developer, as well as Air Carbon, who is building these sort of auction markets, in various regions around the world. So the two things that we've been doing, one is we've been focusing on the attachment of carbon credits to a physical delivery process. When say an LNG client goes into delivery. So that's the key piece of call it technology and workflow that we've been investing in and working with the market in over the past probably over 2 years now. And then the other piece, yes, we have been working on where we think there's a gap in voluntary carbon market futures. that's a bit different than Air Carbon's approach, and different than some of the index approaches that we've seen to date. So again, there's a lot of IP and there's a lot of developments in this space. So this is probably one I can't talk about too specifically at the current time. But again, I do believe, and we've said it in past calls, that we think LNG and voluntary carbon markets are going to be two of the most important commodity future markets over the next 10 years. And so, of course, these are two areas that we're investing in heavily.
Wonderful. We have one new question via the chat around building liquidity over time at Abaxx Exchange. Is it a concern from the market participants about building this liquidity, and what is our response to that?
Yeah, I would say not really. I mean, at the end of the day, what we're really focused on is solving commercial needs. So by nature, this is very different than, say, launching a new competitive, Bitcoin exchange or something where you're trying to take liquidity from others, and it's sort of a zero-sum race, for market liquidity. This is a bit different, right? Like, by nature, the early members and the early traders building up physical market open interest, are people we've been engaging for, more than 2 years. So this isn't sort of launch and then go try to build liquidity. This is really about building physical market, solving physical market needs, and getting open interest into the market. And then, of course, over time, we would bring in more market makers, more arbitrageurs, more CTAs, and aspects of broad futures market liquidity. But again, we take the approach that, for the first couple of years, it's all about building physical market use cases, and building physical market open interest. Paris, next question.
I think we've gone through all the questions. I'm just looking for, I think there's one that I may have missed. With recent filings mentioning that Abaxx Exchange will be using the third-party technology support expiring Bay markets, why not launch the exchange with a third-party clearinghouse first, and then build a market for the LNG contract, and then do the Abaxx clearing later? So what's the thought behind?
Great. Yes. Yeah, no, that's a great question. And again, I think, when we initially went public, we very specifically wanted to wait until we had our first approval in principle on the exchange side. And as we filed in our listing application, we discussed how, in the event of not being able to receive a clearinghouse license from the MAS, we would have the possibility of working with a third-party clearinghouse. And I would say, back to the point of innovation, both on the product side and the technology side, our view is that controlling the full stack ourselves, and having control of new technologies, having control of our own clearinghouse and our own products, allows us a lot of flexibility to be innovative and really push the boundaries faster. One of the problems with working with a third-party clearinghouse is, of course, we would be very set in sort of their technology stacks, their FCMs, the pace of the development of their FCMs as far as technology and new products. And so again, we think from a longer-term investment potential, although more challenging and creating more risks in the short term, it's a much greater value long-term. And again, going back to some of my opening comments at the beginning of the call around valuation, we believe this is a significant, call it competitive advantage or moat is having that full stack. As we've seen in two recent acquisitions that have brought sort of technology challengers, to buying existing clearinghouses, and of course, with FTX, purchasing an RMO and DCO in the U.S., they basically bought those licenses very specifically to try to offer their new technology in crypto markets in a regulated environment in the U.S. So we think that that trend will only continue as new technology changes the nature of the marketplace. You're going to have different participants, looking for different licenses and advantages. And so again, we think from a pure investment perspective, investing in the full stack is the best long-term investment for shareholders, even though if it makes the precise timing of our launch more difficult. So I'm with you, Paris. I'm not seeing any additional comments. Anything else from the emails?
No, not that I've seen come in, but if anyone on the call right now has additional questions, feel free to submit them to the IR inbox, and we can respond to your email via email. I think at this point,
absolutely. Oh, actually, sorry, I do see one other one that's actually an important question, asking about inflation impacts in the carbon credit market, and does this sort of delay carbon markets? I actually view my view is that it does not. And again, our first focus has been on, for many years now, has been on LNG and the new opportunities in risk management and clearinghouses. And of course, as very related to that, again, we believe that LNG combined with carbon offsets are going to be two of the most important commodities in the energy transition. So has this delayed? And I think there was an earlier question about greenwashing as well. Has this delayed the voluntary carbon markets? I don't believe so at all. So there's really two aspects of this market, right? There's the regulated markets, and then there's the voluntary markets. And in the regulated markets, you're right. There may be, with inflation, with pressures on incumbent governments, there may be, at the margin, pressure to sort of roll back maybe some cap and trade systems, loosen some of the environmental, regulations and requirements. But that's actually not what we believe is driving the voluntary carbon markets. We think the voluntary carbon markets and the pledges of net zero from corporations and large global shareholders, we think that trend is still very much in its early days, but building momentum very rapidly. So it's actually going to be some of the key investors in this market, trying to meet net zero pledges, is really going to be the energy companies themselves. And so as you're seeing, increased, call it windfall, profits from current energy prices, we actually see most of these energy companies, double down or even investing even more in voluntary carbon markets because of both the pressure of their employees, their stakeholders, and really the increasing urgency globally, around the issues, regarding climate change. So we actually believe, again, it's a lot of the energy companies themselves, right up to some of the largest energy companies in the world, which are going to be the biggest investors in these voluntary carbon markets, rather than governments, driven by populist policies. So we absolutely think that this market is still just ahead of its hockey stick moment, and we will continue to invest in this market. So I think with that, I think that we, as Paris said, we're happy to answer any further questions by email, and I want to thank everybody for their time today.